All right, let's talk Spotify. Their new earnings report just dropped, and the headline is a massive 200% jump in profits. But as investors, we know the headline rarely tells the whole story. So, what's really going on here? Let's dig in.
So yeah, that profit number, it's exploded by 200%. Looks amazing, right? But here's the deal. Once you peel back the layers, you find some pretty serious warning signs. We're talking about declining user value and some real trouble in their ad business. So is this the full story? Not even close.
Okay, so here's how we're going to break it all down. First, we'll look at the secret behind those soaring profits. Then, we'll talk about a big warning sign I'm seeing with user value. After that, the headwinds facing their ad business. And we'll wrap up with the key questions every investor should be asking right now.
All right, first up, the secret to soaring profits. Let's really deconstruct this impressive headline number.
So the number everyone is looking at is this: 899 million euros. That's their net income for Q3. And just to put that into perspective for you, that is a huge number. And when you compare it to last year, well, that's where you get that insane 200% increase. A jump from 300 million to nearly 900 million. So you gotta ask, where did all that extra cash come from?
So, did this massive jump come from their actual business, from them selling more subscriptions, more ads, or is something else going on behind the scenes?
And well, here's your answer. The core business did okay. Revenue was up a solid 7%. But look at this. A huge chunk of that profit, it wasn't from operations at all. You've got a 197 million euro gain from some fair value adjustments on notes. Then you've got this massive one-time tax benefit of 202 million euros. You add those two up, and that's almost 400 million euros that have absolutely nothing to do with their day-to-day business of music and podcasts.
Okay, so now that we know the profit number is a bit, let's say, enhanced, what about the user metrics? This is where things get really interesting and, frankly, a little concerning.
So on the surface, things look great here. Premium subscribers are up 12% year over year. That's fantastic growth. You can't argue with that number. But, and this is a big but, the average revenue they're making per user, what we call ARPU, has actually declined by 4%. Think about that. They're adding more users, but each one is bringing in less money. That is a trend that should absolutely get your attention as an investor. So what's the company's explanation for this? Well, management is pointing to a couple of things. They're getting hit by foreign exchange rates that took off about 18 cents, and then there's a shift in their product and market mix, which took off another 14 cents. They did have some price increases, which helped a bit, but it just wasn't enough to offset the headwinds.
And this really brings up a critical long-term question, right? Is Spotify just chasing user growth at all costs, even if it means sacrificing the value of each user? It's a classic growth versus profitability dilemma.
Okay, so if the value per subscriber is going down, you'd hope the ad business is picking up the slack, right? Well, let's take a look because this is where another red flag pops up.
Yeah, their ad-supported revenue actually fell by 6% year over year. It went from 472 million down to 446 million. Now, in a market where digital advertising is generally growing, seeing a decline like this, that is definitely not what you want to see.
And to understand why it's falling, you have to know how they sell their ads. They basically have two buckets: the direct channel, where their sales team makes deals directly with big advertisers, think big brands and agencies, and then there's the programmatic channel, which is all the automated auction-based stuff.
So what did management say? Well, the weakness is coming almost entirely from that direct sales channel. It was down 34 million euros. Meanwhile, the automated programmatic side was actually up 23 million. The main reason they gave was a drop in music impressions sold through that direct channel. It's kind of like their high-touch, premium sales force is struggling, while the self-serve, automated machine is chugging along. That's a weird mix. Okay, so we pulled apart the profit numbers, we've looked at the user value problem, and we've seen the weakness in the ad business. So what does this all mean for us as investors? What are the big questions we need to be asking heading into the next quarter?
I've boiled it down to 3 critical questions. First, can this level of profitability be sustained, or was this quarter just a one-off boosted by those financial and tax tailwinds? Second, what is the long-term plan to turn around that declining ARPU? They can't grow users forever if each one is worth less. And third, how are they going to revitalize that ad business, specifically that struggling direct sales channel?
So when you look at this report, yeah, the headline is strong, but does it really signal a stronger long-term competitive advantage?
That's the real question. Because underneath that impressive profit number, there are underlying trends in user monetization and advertising that frankly need some very careful monitoring going forward.